Ruth and Helen have been neighbors in Louisville, Kentucky for 22 years. They are both in their mid-70s. Both lost their husbands in the past 5 years. Both had IRAs in the range of $1.8 million, built over decades by two couples who saved carefully and spent modestly. Both received Social Security. Both paid taxes without incident for as long as either of them could remember. Last February, Ruth sat down with her tax preparer for the first time as a single filer. Her federal tax bill came to approximately $12,600. The year before, when her husband was still alive, their joint return produced a bill of roughly $7,100. Same income, same IRA, same Social Security, same RMD from the same account, $5,500 more in tax. And Ruth's first question was the one most people ask. Why? Her tax preparer used a phrase Ruth had never heard in 48 years of filing tax returns together with her husband: the widow's tax penalty. Helen, 2 streets over, had a different experience. Her husband passed 4 years ago. She knew the phrase was coming before he died. Her federal tax bill last year was approximately $7,200, lower than what Ruth paid on what was, functionally, the same income. The difference between Helen and Ruth was not their money, their age, or their luck. It was one conversation Helen's husband had with his advisor 5 years before he needed it. Let me explain what the widow's tax penalty actually is, because it is not one thing. It is 6 things that arrive at the same moment, on the same tax return, with no warning. The first 2 arrive together when you file as a married couple, and both spouses are 65 or older. Your standard deduction in 2026 is $35,500. The moment you become a single filer, which happens the year after your spouse dies, that deduction drops to $18,150. $17,350 more of your income is now taxable. Not because you earned more, not because your spending changed, because of a line on a form that now says single instead of married. That alone changes the tax picture. The second layer makes it worse. The tax brackets for single filers are roughly half as wide as the brackets for married filers. In 2026, a married couple does not reach the 22% bracket until their taxable income exceeds $105,700. A single filer hits the 22% bracket at $50,401. Ruth's income flowed through the 22% bracket on a portion of her RMD that, the year before, sat comfortably in the 12% range. The rate changed. The income did not. Run these 2 numbers on your own situation before you continue. Take your combined annual income, your RMD, your Social Security, any pension or other income. Subtract $35,500 if you are filing jointly. Subtract $18,150 if you are single. See where the difference lands in the tax brackets. That gap, the difference in taxable income between those 2 filing statuses, is what the widow's tax penalty costs before any other factor enters the picture. The third layer involves Social Security. When your combined income crosses $34,000 as a single filer, up to 85% of your Social Security benefit becomes taxable. The IRS calls this the provisional income test, a formula that adds your adjusted gross income, any non-taxable interest, and half of your annual Social Security benefit. For married couples filing jointly, that threshold is $44,000. Consider what this means in practice. Tom and Sarah were married, and together brought in $36,000 in combined Social Security, plus $25,000 from their IRA. Their provisional income, adding half of their Social Security, came to $43,000, just under the $44,000 joint threshold. 50% of their Social Security was taxable, manageable. Tom died. Sarah's income dropped. She lost Tom's smaller check and kept his larger survivor benefit, bringing her Social Security income to $24,000 a year. Her provisional income as a single filer, $37,000, above the $34,000 single threshold, 85% of her Social Security now taxable. Sarah lost $12,000 in annual income. Her tax burden on what remained went up. That is the third layer of the widow's tax penalty, and it is the one that surprises people the most because the logic feels backwards. Lower income, more taxed. Run this number today. Add half of your annual Social Security benefit to your other retirement income. If that sum crosses $34,000 for a single filer, 85% of your Social Security is taxable. If you are still married, your threshold is $44,000. The gap between those two numbers is the exposure you are carrying. The difference between what your surviving spouse will face and what you are facing now. The fourth and fifth layers involve Medicare, and they compound each other. Medicare uses what planners call the IRMAA lookback. Your 2026 premium is calculated from your 2024 tax return. A married couple with combined income of $135,000 in 2024 filed below the joint IRMAA threshold of $218,000 and paid the standard Part B premium. When one spouse dies in 2025, the survivor's income drops, perhaps to $110,000. But the 2026 Medicare premium is still based on the 2024 joint return, when income was higher. The surcharge arrives before the income that triggered it has even continued. And going forward, the single filer IRMAA threshold is exactly half the joint threshold, $109,000 in 2026, compared to $218,000 for couples. A surviving spouse with $110,000 in annual income has crossed the line by $1,000. The extra Medicare surcharge that adds approximately $1,150 per year on lower income than the couple had when they were both alive. If your spouse passed recently and your 2026 Medicare premium seems higher than you expected, there is a remedy worth knowing. The death of a spouse qualifies as a life-changing event under Social Security's rules. Filing SSA Form SSA-44 asks Medicare to use a more recent tax return rather than the 2024 joint return, one that reflects your current income as a surviving spouse. It does not always work, but it is worth filing. The sixth layer is a window that closes without warning if you are not watching for it. There is a filing status most surviving spouses have never heard of, called qualifying surviving spouse. It allows you to file at joint tax rates for 2 years after your spouse's death, which can meaningfully reduce your tax bill during that transition. The catch: it requires a dependent child living with you. For most retirees, that means it does not apply. The benefit disappears. But the window in the year of death itself, the year your spouse actually passes, is different. In the year of death, you can still file a joint return for that entire tax year, regardless of when your spouse died. That window closes December 31st of the year of death and never reopens. It is the one tax advantage most surviving spouses do not know to use while they still have it. Helen's husband used the 5 years before he died to do something deliberate. Their advisor had explained the widow's tax penalty to both of them clearly, not as something to fear, but as something to plan for. They spent 3 years doing strategic Roth conversions, specifically to reduce the traditional IRA balance that Helen would eventually inherit as a single filer. Less traditional IRA balance meant a smaller RMD each year. A smaller RMD meant less ordinary income on Helen's return. Less income meant she stayed in a lower tax bracket, stayed below the IRMAA threshold, and triggered less Social Security taxation than Ruth, even though their situations on paper looked nearly identical. He did not do it to save himself money. Most of the tax benefit would not arrive until after he was gone. He did it because he understood what the tax code does to the person left behind. For your specific IRA balance, your Social Security amount, and the years remaining before your spouse might face this situation, a CPA or fee-only financial advisor can model the exact Roth conversion amount that reduces the widow's tax penalty for your household. The right strategy is different for every couple. The right time to have the conversation is while both of you are still here to have it. The one move worth making this year, if your spouse is still alive. Ask your advisor to calculate your household's projected tax bill if one of you died tomorrow and the survivor filed as single. See the number, then ask what Roth conversions, done now, could reduce it. The answer to that second question is how Helen's husband spent 3 years. It is how Ruth wishes someone had spent 3 years for her. Ruth found out in February. Helen's husband found out 5 years before that. The information was the same. The timing was the only thing different. If your spouse is still alive, if you are watching this together, or if you will share it, the widow's tax penalty is a conversation worth having before it becomes a bill you did not expect. Nobody explains it at the funeral home. Nobody explains it at the Social Security office. Nobody handed Ruth a document in the years before her husband passed that said, "Here's what happens to your taxes the year after he is gone. And here is what you can do about it while you still have time." The 6 things the widow's tax penalty does to a surviving spouse's return. The standard deduction that is cut nearly in half. The tax brackets that compress on every dollar of income. The Social Security threshold that drops for single filers. The Medicare surcharge that kicks in on income a joint return never touched. The 2-year lookback that charges premiums based on a household that no longer exists. And the joint filing window that closes December 31st of the year of death and never reopens, arrive at the same time, on the same return, with no warning and no explanation unless someone thought to provide it in advance. 6 things, 1 surviving spouse, 1 tax return that nobody prepared her for. Subscribe for a new video every week on the retirement rules most people find out about after the fact.